Welcome to Hope Matters Radio.
We have Ed Doran of Isdaner and Company. He's a CPA that focuses on your taxes, if it's personal, if it's entities, if it's nonprofit. We have Lori Ravitch from the Hope Mortgage team at Gateway Funding. She's an operations manager and one of the head underwriters, filling us in on how do we take what you've done on your taxes and put that into a qualifying income perspective so that you can obtain the financing and mortgage you need. And our lovely co-host today, Diane Garvey of Harvard Abstract, she's tearing into the question. So Diane, as we get back to this self-employed income, W-2 income, what we've shared thus far, where do your questions fall?
I would like to start with trust. Why would somebody set up a trust? What is the benefit of that?
A lot of times when you see real estate in a trust, it's usually what's called a revocable living trust. And why people will do that, not only real estate, but to put other assets in there, is to avoid what they call the probate process. If you put the assets in a revocable trust, at that point, the trust document determines the distribution of those assets at your death. And they are protected in the trust, and the distributions go through the trust document. If you don't have them in a revocable trust, hopefully you have a will, or the decedent has a will. The will determine the distribution of the assets upon your death. However, the will has to go through the probate process. The probate process could be lengthy, costly, and complicated. So a lot of times people will put it into the revocable living trust to avoid all of that complications. We love attorneys, but the attorneys will get involved, the court system, probate, like I said, probate costs, so you don't have to deal with any of that. So that's most of the times you'll see the real estate in a revocable living trust. Other times when someone passes away, they'll create a trust upon their death, which is called a testamentary trust, and they'll say, I want my assets to go into a trust. My children can live there for their lifetime, and that stays in a different type of trust. Why they did that, there could be plenty of reasons of why somebody wants to put real estate into a testamentary trust. It all has to do with estate planning. There could be a specific reason why they put that into a testamentary trust when they die.
And I think you bring up the key word out of everything that's just been shared, planning. If we pass away, unfortunately, we're no longer here to, let's say, carry out our wishes for the heirs that we leave behind, for the assets that we leave behind, possibly for the liabilities that we leave behind of debt and expense that our family has to deal with. It's an unfortunate situation, but nobody gets out of this life alive. And that's where the estate planning comes in.
Exactly. And people, like you said, don't want to deal with it. I guess people don't want to deal with death and the idea of death. So to get everybody to sit down and talk about it, that's the first step. Everybody's got to realize that we all, no one gets out here alive, the old Jim Morrison book. Somebody's got a plan, because if not, estate taxes, inheritance taxes, all kinds of taxes, we talked briefly, generation skipping taxes, there could be so many issues that you have to deal with. And if you did not sit down with, it's a team approach. Your accountant, your attorney, your life insurance guy, your real estate people, everybody's got to sit down together, and everybody's got to understand the plan. I'll get phone calls from clients saying, listen, I'd like to do this with a piece of real estate. And I would say, well, did you talk to your attorney? I'm not going to tell you to do something with a piece of real estate if he's already put a plan together that says you don't do that with that real estate. So I never will say, yeah, go ahead, that's a good idea. Why don't you do this or do that? It's like, have you talked to your attorney? I wanted to buy some life insurance. Do you have a life insurance person? Do they deal with your attorney on your estate plan? So it's planning and a team approach to planning.
Sure, and I think that's really where the financial concierge model that we've built really comes into play. And that's as easy as making a phone call to get all of these people coordinated. It starts by calling 855-775-HOPE. That's 855-775-4673. As Ed shared, it's getting your real estate professional, your tax planner, your estate planner, your financial or asset manager, your realtor, your attorney, getting everybody on the same page. You don't have to call all of them. We'll take care of all of that for you. Lori, on the mortgage end, get ready to be ready. Start your mortgage planning 6 months, a year ahead of time.
Yes, as underwriters, we like to look at tax returns ahead of time. If you know you're planning on purchasing a home, get in touch with James, send in your tax returns, let us look at everything ahead of time so we know what kind of qualifying income we can calculate.
But the big thing is, it's only a pain in the butt when we're in the 9th hour and it's crunch time.
Hope Matters Radio is brought to you by the Real Estate Radio Network. Visit hopemattersradio.com for more information. That's hopemattersradio.com.